$38 trillion. That is America's national debt right now, not a guess, not a future estimate, not a projection for the next decade. It is the real number sitting on the books as of December 2025. And if you believe that number has nothing to do with your job, your savings, your mortgage, or your children's future, then you need to stay with me very carefully. Because while most people were busy scrolling social media, watching Netflix, arguing about politics online, and living normal daily life, something very serious started happening behind the scenes. The largest financial institutions in the world began moving money. Not small amounts, not symbolic shifts, massive amounts of capital, quietly, carefully, systematically. They started reducing exposure to dollar-denominated assets. No big headlines, no dramatic announcements, no emergency press conferences, just steady movement. And this is not a conspiracy theory. It is not a rumor. It is documented capital flow. It is visible in public filings. It is visible in treasury data. It is visible in central bank reserve reports. The numbers are public. Anyone can verify them. By the end of this, you will understand what is happening, why it is happening, and what usually happens next. Because this is not random. There is a pattern, a mathematical pattern. It has played out 3 times in the last 500 years. The same stages, the same warning signs, the same outcome. And right now, we are watching those stages unfold again in real time. The only real question is whether you will recognize it early, or whether you will look back years from now and ask yourself how you missed something that was sitting in plain sight. Global debt just crossed $251 trillion according to the International Monetary Fund. That is 235% of global GDP, the highest ratio in recorded peacetime history. The United States alone increased its debt from $36.1 trillion in January 2025 to $38.4 trillion by December. That is a $2.3 trillion increase in just 11 months, nearly $210 billion per month, around $7 billion per day. But here's what most people are not being told. This exact structure has happened before, 3 times in modern history, and each time, the country that controlled the world's reserve currency lost that position within roughly 3 years after major capital began leaving. Not similar outcomes, not partial declines, full systemic shifts. The timeline is not perfect to the exact month, but the structure is consistent. Once the smart money exits in size, the clock starts ticking. Every major economic collapse over the last 5 centuries followed 4 stages. Stage 1 is the ascension phase. A nation becomes the center of global finance. Capital flows in from everywhere. Investors trust its institutions. Its currency becomes the standard for international trade. Businesses settle contracts in that currency. Commodities are priced in that currency. Banks expand. Markets boom. Innovation accelerates. Confidence becomes absolute. The stage usually lasts between 50 and 80 years. It feels unstoppable while it is happening. Stage 2 is overextension. Success creates confidence. Confidence turns into arrogance. Governments begin spending beyond their means. Military expansion grows. Foreign interventions increase. Social programs expand. All funded not only by tax revenue, but increasingly by borrowing. Debt begins growing faster than the economy itself. At first, nobody panics. Asset prices continue rising. Real estate booms. Stock markets reach record highs. Retirement accounts look strong. People feel wealthy. Central banks support the system with low interest rates and money creation. This phase can last 20 to 40 years. It feels normal. It feels sustainable. It feels permanent. Stage 3 is the silent exodus. This is the most important stage. It is also the quietest. The public does not notice it at first. Politicians rarely admit it. But institutional capital begins rotating elsewhere. Sovereign wealth funds diversify. Foreign central banks slowly reduce reserve allocations. Large families with generational wealth shift holdings internationally. The exits are gradual at first, then they accelerate. This stage usually lasts 18 to 36 months. Stage 4 is collapse or transition. The currency loses reserve dominance. Foreign buyers disappear or demand much higher interest rates. Inflation accelerates. Interest rates spike. Asset prices fall. Banking stress spreads, pensions weaken. The middle class absorbs most of the damage. Political instability increases. And almost everyone asks the same question. How did this happen so fast? The answer is simple. It did not happen fast. It happened in stages. People just ignored the early stages. Now let us look at history. In the 1500s, Spain was the dominant global superpower. After the discovery of the Americas, Spanish ships returned loaded with gold and silver. The Spanish real became the global reserve currency. International trade required it. Madrid became the financial center of Europe. Wealth poured in from colonies across 3 continents. Under King Philip II, Spain controlled vast territories. Its military was feared. The Spanish Armada dominated the seas. Confidence was complete. Stage 1 had fully formed. Then spending expanded. Spain fought wars with France, England, the Ottoman Empire, and the Dutch. Maintaining armies across continents required enormous capital. Royal courts lived extravagantly. Bureaucracy expanded. By the mid-1500s, government spending exceeded revenue by multiples. Spain borrowed heavily from European banking families. Gold shipments continued arriving, so markets stayed calm. This was stage 2. Then the shift began. Major creditors demanded repayment in hard metal instead of future promises. Banking families began transferring operations to more stable cities like Genoa and later Amsterdam. Merchants diversified, quietly. Interest rates on Spanish debt climbed to extreme levels, reflecting fear in the credit markets. That was stage 3. Spain defaulted in 1557, then again in 1560, 1575, and 1596. Repeated sovereign defaults destroyed confidence. Inflation damaged the economy, military dominance faded. Within decades, Spain was no longer the financial center of the world. Capital had already relocated north. Next came the Dutch Republic in the 1600s. Amsterdam became the new global financial hub. The Dutch East India Company was one of the most valuable enterprises in history. The Amsterdam Stock Exchange was the first formal stock exchange. The Dutch guilder became the reserve currency of its time. Capital flowed into Amsterdam from Asia, Africa, and Europe. Trade networks expanded. Banking innovation flourished. Stage 1 repeated. Then, military conflicts expanded. Anglo-Dutch wars, conflicts with France and Spain. Overseas defense commitments multiplied. Government debt surged dramatically over several decades. Asset bubbles formed. Tulip mania became a symbol of speculation. The Bank of Amsterdam, once considered the safest institution in Europe, quietly began lending depositor funds to support government spending. Financial discipline weakened. Stage 2 unfolded again. Then capital slowly shifted toward London. Banking families diversified. Merchants relocated operations. Foreign investors reduced exposure. The public narrative remained optimistic, but insiders saw the balance sheet stress. When French forces invaded in 1795, the system was already weakened. The guilder collapsed. The Dutch Golden Age ended. Capital had already prepared its exit. Stage 4. Then Britain rose. From the 1700s into the early 1900s, the British Empire dominated global trade. The pound sterling served as the world's reserve currency for over 2 centuries. London was the financial heart of the planet. British banks financed global infrastructure. Trade settlements occurred primarily in pounds. Confidence seemed permanent. Then World War I changed everything. Britain's debt surged from manageable levels to over 130% of GDP. Attempts to restore the gold standard failed. Economic strain deepened. World War II pushed the country even further into debt. Britain won militarily but was financially exhausted. After the war, large corporations increasingly invested in the United States. The U.S. economy was growing faster. American industrial capacity was intact. The dollar strengthened. In 1944, the Bretton Woods system formally placed the dollar at the center of the global monetary order. By the early 1950s, sterling had clearly lost reserve dominance. The transition took several years, but the direction was clear. Stage 3 had quietly occurred during and after the wars. Stage 4 was not a dramatic collapse in Britain's case, but a permanent loss of financial supremacy. Now look at the present. The United States has been the global reserve currency issuer since the mid-20th century. The dollar dominates international trade. Commodities are priced in dollars. Central banks hold the majority of reserves in dollars. U.S. Treasury bonds are considered the safest and most liquid assets in the world. But debt has grown consistently faster than GDP for decades. Interest expenses are rising rapidly. In some recent years, interest payments alone have approached or exceeded defense spending. That is a structural signal. Foreign ownership of U.S. Treasuries, while still large, has shown periods of stagnation or reduction relative to total issuance. Some central banks have increased gold reserves, others have diversified into different currencies. Bilateral trade agreements outside the dollar system have increased modestly. None of these factors alone prove collapse. But patterns are not about one data point. They are about structure.